Welcome to Market Matters video update for this week. It's the 28th of July today. We've had the ASX punch through all-time highs earlier this week. It's having a little bit of a rest today, only down a few points at the moment. But as we head into reporting season, we're going to chat about 6 stocks in the portfolio, some winners, some losers, get an idea of where we see them into perhaps reporting, what we'll do with them before and after they report. But kicking things off with the good, we bought Oz Minerals last week, and that's been a pretty strong start to our holding there, James. They've had production report out this week. What's your take on Oz?
Yeah, a good set of production numbers out this week for Oz Minerals. So they had high production and lower costs. So that's really strong for margins and earnings going forward. So we're bullish on the outlook for copper. Copper retreated in the last couple of months down to near $4 a pound. It's now back up to about $4.50. We've got a target around $5 a pound for copper. So Oz Minerals is going to follow that. So look, it's operationally performing well. It's got a tailwind from the underlying commodity price. So bullish and holding, Harry.
Certainly one, the stock that we hold that's certainly had a tailwind from their commodity price is BHP. Iron ore has been stronger than people expected, held up pretty well in the sort of the face of people calling that to fall over the last few months in particular. BHP touched all-time highs this week as well. Are we letting that one go into reporting or we'll see that one through?
No, I think it looks phenomenal here, BHP. It's all in the right areas. So you touched on iron ore, which I think is important. I think it's important around how we're positioned in the commodity complex at the moment. So we've got BHP because it's more diversified. It's obviously got iron ore, but it's got other energy assets, copper, etc. In there. So it's a more diversified exposure there. I think there is a risk around iron ore going into the second half. So, the first half was stronger than many anticipated. There was lower supply coming on stream at a time when lower supply coming on stream at a time demand was really strong, probably stronger than the market was anticipating, particularly coming out of China. If we look into the second half, I think we're going to have the opposite of that play out. So rising supply is about 60 million tonnes coming on stream in the second half, and falling demand. So demand's going to be down on most estimations by about 40 million tonnes per annum. So in my view, the iron ore price goes lower in the second half, but these miners are printing massive profits. They're going to pay massive dividends. Rio reports its half-yearly earnings after market today. So watch out for that one. We're expecting about a $12 billion profit for the half. So that speaks to how well they're obviously going. We remain bullish BHP, targeting $60, but more neutral on the likes of Fortescue and Rio, which iron ore is dominating their books.
Certainly, yeah. Some people calling Rio to pay more than a $5 dividend as they report half years this afternoon. They're elsewhere, so they're 2 stocks we own in the growth portfolio. Looking out to the smaller end of the curve, Temple and Webster, they did really well yesterday on their full year results. They sort of kicked off reporting season more or less from those guys. It was a good number. They were up pretty strong. They did pull back from the intraday highs there, James, but some pretty good numbers from TPW.
Yeah, this is a stock in your portfolio, the emerging companies portfolio, Harry, as you know. Great set of numbers, and they sales are up, margins are up. These businesses are all about scale and generating that concept of operational leverage. So the more volumes they do, the more economically they push those volumes through, the more positive it is for earnings. And you get this big uplift in earnings, which we saw in the results yesterday. So Temple and Webster, we like it. We think the online thematic is alive and well, particularly as Gladys has just gone out there and announced another 4 weeks of lockdown here in Sydney, which we're all stoked about. But yeah, Temple and Webster looks good for mine for further upside. And just broadly you touched on the reporting season, Harry. We're going into a reporting season, full year reporting season for the ASX. The market's expected to grow, or EPS, aggregate EPS at the index level, is meant to be up 50% on this time in FY20. So clearly a really strong number, plus guidance for FY22 is expected to be an aggregate earnings growth of about 10%. So corporate earnings remain really robust here, and we're seeing that in some of the first companies that have reported. I think we'll see that when Rio reports this afternoon.
Yeah, certainly. So looking at the bad stuff now, James, Crown, they've had a few issues of late. They had some corporate interest that seems to have walked away from them at the moment. They're pulled back to around about the $9 mark. They had some better news today with their Melbourne operating conditions there, James. But is this one we expect to bounce out of here?
Yeah, I'd hope so. I mean, it's been a debacle, really, the Crown position. So we obviously bought it pretty well. We then saw a takeover offer, which we're anticipating. We didn't sell into the offer. I wrote yesterday afternoon that I had a large fund sort of bid our line of stock at $13, and I didn't. We didn't take it, which was now a mistake. You then think about what's going to go forward in terms of Crown. So we're at 886 at time of recording. We're now 1.6% today. Obviously, the Royal Commission outcomes are weighing on the stock, but also this sentiment around China. So the bid on the table from Blackstone was worth $12.35. They knocked that back, and there is a merger proposal on the table which values it about $14. We think the stock's worth about $12.50, $13 now, and obviously the Royal Commission findings are going to weigh into that. But yeah, we're holding it for now. Not going to add to it, just given the risk profile that it's got coming out of the Royal Commission. But yeah, happy-ish to hold it now, given where it's come from and the fact that we should have sold it at higher levels, Harry.
Certainly. Another one that's sort of been a thorn in the side for a few months now, A2 Milk, did seem like it was finding its feet over the last couple of months, but given some of that back now, where do we see A2 Milk in a month or two's time, James?
Yeah, I wrote this morning that we are considering selling A2 Milk simply from a risk perspective. It's trading at $6.01 at time of recording, so it's up marginally on the session. A couple of things playing out here. Obviously, from a broader context, A2 has been hurt because there's more local brand name formula that is becoming more popular in China. So the demand for the A2 product has lagged. They've had a huge amount of inventory, so they've had to discount and get rid of product, if you like, similar to what Kogan has had to do in the electronic space. But the news this week around China sort of targeting the costs of raising children in that part of the world, they want more kids to be born, has been a negative for A2 in the short term. I thought, moving to a 3-child policy would have ultimately, and then encouraging people to go down that path would have ultimately been a positive for A2 Milk. So we're in two minds at this stage. So I see the risks in China, and I see what they're, that we've got a little bit too much exposure into that risk, particularly in our international portfolio. So I'm cognizant of that. But again, A2 Milk was on the improve. The market was bidding it up into these results. The market was incredibly bearish leading into these results. So for now, we're watching it and seeing, Harry. If it gets worse, we'll probably cut it from a risk perspective. But at the moment, we're holding fire.
Yeah, certainly. We touched on China a lot there. China Tech has certainly been in the firing line over the past week in particular. The last few sessions have been pretty dire over there. We're finding sort of a low in that. You wrote that you were neutral sort of China this morning in the morning report, James.
It's been a debacle, what's played out in China in the last week or so. You've seen massive moves in China-facing or domiciled technology companies, not to mention the education providers. There's some education companies out there that have basically 95% of their value off them. Tech has been hit by, obviously, but not by as much. We bought JD last week. We're likely to cut that, take a small loss on the position and move on, simply because of this exposure in China. We've also got Alibaba in the portfolio, and we've got Tencent in the portfolio. So for now, we'll probably hold Tencent, we'll probably hold Alibaba, and we'll probably jettison JD purely from a risk perspective. I think those businesses are worth more than they're trading at the moment. But the question mark is what China does going forward, and it's an unknown. So we've got to price that. And I look at that portfolio and I feel like we've got too much exposure, or we do have too much exposure to a volatile part of the market.
Certainly. All right. That's all for today, James. Good to see your face for the first time in a week. And, I love the black shirt uniform we've got going on here.
Thanks, mate. It's a warm day in Sydney. It's 24 outside. So, yeah, anyway, good to see you, mate. And we'll talk soon.